Thank you all for being here early. We're having this conversation at a challenging point in the Australian business cycle. Interest rates have been higher for longer, cost pressures remain pretty high on SMEs, and margin pressures across SME industries are still pretty high as well, we've seen. Refinancing is harder, bank credit's more selective, and the assumption that there'll always be an easy takeout doesn't really hold anymore. For brokers in particular, that has changed the game. Deals aren't just being assessed based on serviceability today, they're being judged on how they realistically end. Credit teams, private lenders, valuers, and restructuring advisors are all asking the same question much earlier. What is the actual exit? Who is going to execute it? And what happens if that doesn't go to plan? And so in recent times, we've kind of seen something emerge where exits aren't really exits at all on deals. Some borrowers have effectively been jumping from one credit fund to another, increasing the leverage, stretching asset values, and pushing OVRs just to keep going. In the short term, that's probably a solution, but the challenge here in reality is it often erodes equity until the music stops and the client's left with nowhere to go. So when we talk about selling the exit, this isn't just about getting a deal approved, or ticking a box for credit. It's about preserving the value of the client and their net asset position. And that's what today's about. The session's called Sell the Exit, Sell the Deal. Because in private credit especially, a strong exit doesn't just protect the lender, it often determines whether a deal gets done at all. Weak, assumed, or wishful exits are often one of the biggest reasons transactions stall, get recut late, or fail. This morning we'll unpack what a credible exit really looks like from three perspectives: a private credit lender, a valuer, and a restructuring advisor. We'll advise the exit pathways that generally work, the early warning signs that an exit is deteriorating, and how brokers can present exits in a way that teams actually believe. Now, I've got a great panel for you guys this morning. Rather than me reading out their bios, I'll let them do a much better job themselves. I'll ask each panelist to give a quick elevator introduction, who you are, what you do, and how the question of exit shows up in the world as it crosses your desk. We'll start with you, Nick.
Thank you, Sayed. I'm Nick Samios, and I'm the Managing Director of Hermes Capital, and have been since our foundation 16 years ago. We've been in private credit for all those years, before private credit was cool, really, before people called it private credit. And I guess we're lending against all sorts of assets, including accounts receivable and plant and equipment and property. The beautiful thing about accounts receivable is you don't really need to worry about the exit, because the exit's built in. The account pays, hopefully, and you've got your money. So I guess as asset-based lenders, we're heavily focused on getting out two ways: either the facility paying within terms, or if it all goes wrong, hopefully we're going to get out on the assets and stay in one piece ourselves. Hopefully the borrower gets to stay in one piece as well, if we're able to exit orderly. But I guess as asset-based lenders in the distress space, we're in special situations. So having to fall back on assets isn't a hypothetical for us. It's something that can really happen. For many years, I was in the bank. I was in banks. I was at a Japanese bank. I was at Westpac, and we used to lend theoretically against assets, but you had a 1% loss ratio or whatever it was. It was very rare that you'd have to actually go out and get your money back. And whereas in our distress-based exits are a reality, having to think about the exit and make sure that there's a credible exit can be the difference between doing the deal and not doing the deal. If particularly where LVRs are high, or leverage against, if someone's wanting us to lend all the way to 80% on a property and all the way to 80% on a plant and equipment valuation, then you want to have a pretty clear strategy for that exposure coming down or getting paid out. So that's how it impacts me.
Awesome. Richard.
Thanks, Sayed. My name is Richard Lawrence. I am a director at Mackay Goodwin. I'm a registered liquidator and have been doing insolvency for about 20 years. I obviously work heavily in the restructure space, have dealt with private credit matters for a long time. They are becoming more and more prevalent, obviously, especially in the current environment. The private credit really comes in from my end when it's mainly for a restructure. A lot of the times that is restructuring and exiting old financiers as part of an overall restructure of the business. Part of that is providing new facilities to allow the business to trade and hopefully restructure its finances to be able to recapitalise the business and trade on successfully. A lot of the time that has traditionally been through a voluntary administration and a deed of company arrangement. They sort of quietened down post-COVID a little bit, but they are certainly coming back into the marketplace. I've also seen over the last 12 to 18 months private credit lending for directors to fund small business restructure plans. A lot of the time funding against personal property to be able to put an upfront payment to the ATO to make it more enticing for them to accept. ATO has become more difficult in relation to small business restructures, so that's still a credible option in relation to offering an upfront payment. And the other part is obviously private lenders against mortgage properties. That still remains a mainstay. There's quite a lot of enforcement going on at the moment, both in commercial and residential properties.
Thank you, Richard. Ian?
Okay, Ian Hyman's Valuers and Auctioneers. I'm the CEO. Have been for 43 years since foundation. Started off life as a plant equipment valuer, business valuer. We moved into property valuations about 25 years ago, so we sort of cover the full range of assets, hard assets you would expect to see in a restructure refinancing scenario. I'm also the chairman of Professional Risk Managers, which is an insurance broking firm that sort of works around specialised risk within distressed exposures, and that's quite a challenging scenario for brokers when it comes, and for borrowers when it comes time to trying to insure assets in distress, because most insurers actually don't like moving into that space if they can avoid it. One of the things, I guess a lot of the things that we see at the refinancing stage, I call it the Dreamtime effect, and the borrowers that we deal with. Often we've got a combination of borrowers, brokers and funders directly that we work with. And the Dreamtime effect is when a borrower thinks the valuation of his property or assets is substantially higher than the market, or that their credit score out in the general world is much better than it really is. So a lack of preparedness to understand that financing can take a lot of time. Not everyone works at the speed of Hermes Capital and turns things around in a couple of weeks, but if you're with one of the major lenders, and that's where your history has been, it can take 2, 3, 4 months and longer to get a refi organised. And often, obviously in this space, you don't have 2, 3 or 4 months. By the time a borrower realises that, often we're getting a phone call to say, I need a valuation in 3 days of a site that might be worth $20 or $30 million, and we're going, sorry fellas, that's just simply not possible for a range of reasons. So we get a lot of pressure on us from the brokers, from the borrowers. We work a lot in the broker space, so about 40% of our fees gets referred directly from brokers. And obviously, as in any industry, we have great brokers we work with, and we have some brokers that make life very challenging for us and don't ask the right questions. And I hope to uncover some of those issues that we experience through that process as we go through today. But certainly I think the value perception and this lack of understanding of timing is probably the two key things that we see that really can destroy an effective exit for a borrower. And often it's the borrower that's delaying some of those decisions as well that cause those problems.
Thank you, Ian. So back to you, Nick. So when you assess a private credit deal, how much weight do you really put on that stated exit, and what separates a credible exit from a weak one?
It's interesting because I think that again, because of the space that we're in, typically we're dealing with borrowers that they're not refinancing to get a better rate. They're refinancing because they need to raise some extra capital. Maybe they've got a tax bill or something that's pressing creditors, or maybe they're trying to avoid landing on Richard's desk, or maybe they are on Richard's desk already, and it's a matter of refinancing the bank and et cetera, et cetera. And the question for us becomes how do we know that that this isn't going to end up in the same position in 6 or 12 months' time? So, and I think at the moment there is an epidemic. You touched on it before, and I don't know if you're seeing it, Richard, but there is an epidemic of pass the parcel at the moment. So, because there hasn't been a planned exit, you see the borrower go from the bank at 8% per annum to someone else at 12%, and then it's then it might be on my desk, and then the next thing you know, we had one. We were owed $2 million, and the people that paid us out took a $400,000 success fee up front, and the rates are high. And what's happening in that scenario is, of course, we want to plan the exit because we want to get our money back. We're here for the investors in our fund. But you also hate to see a small business that's battling hard to put food on their families' tables, and every time they get these bad exits, they've got less ability to turn their business around. And in America they've got Chapter 11 as opposed to the voluntary administration. They call about Chapter 22 when it comes through again. I don't know what we call the VA squared in Australia, but the trouble is every time that happens, there's less buffer, and there's less ability to bounce back. So look, when we're looking at a deal where the lower the LVR, the less you're concerned about the exit, obviously. But where the LVR is high and it's come from a tough situation, you're wanting to know how are we going to get out? You're wanting to know what are the exact reasons, like what happened to get the business into this situation, and what's going to change it while it's in our care for the next 6 or 12 months. What's going to change that's going to make an exit credible? How, like for example, if the exit's going to be refinance, which is the offer one, how are we going to get exit? Oh, we're going to refinance. Okay, well what's going to change on this file? How is this file going to be de-risked between now and when you present this to Judo Bank in 12 months' time? Often poor old Judo are the ones, oh no, we've got... It's going to be Judo. Judo have said they'll do it. How is this file going to be de-risked? Why isn't Judo doing this deal today? And I don't want to just keep picking on Judo, but the ones that seem always to come up. Why aren't they doing it today? How are those barriers going to be removed? In this plan, what's the backup plan? What happens in 12 months if the bank doesn't refinance? And this is one where, sometimes, we're asked to capitalise interest, or we're asked to do interest only, in these scenarios. And the problem with that, where you're relying heavily on a refinance, is if the refinance doesn't happen, we're still at 75, 80% LVR, whatever it might be, in 6 or 12 months' time. And what happens now? It hasn't been de-risked. And I guess, that's that. And I guess what we're looking for there is then, how can we de-risk that? Can we get some amortisation in, or what other failure points can we see in the deal that make it easier for us to step in and maybe force an earlier exit, if that's what's needed. But there has to be credibility. There has to be a backup plan, and I'm always wary of the exit is refinance through the bank in 12 months' time, because that to me is a hit and a hope, and I don't want it to be a swing and a miss.
Sure. Can I just add something on the LVR discussion? It's really interesting. We're on like 90 property funder panels. There are hundreds of funders out there. The proliferation since COVID has been just extraordinary. And LVRs vary from property types to geography to the type of lend, from land banking to construction, residential, commercial construction through to straight residential, commercial, etc., and unique or specialised property. And the LVRs vary across all of those things, and then between lenders, those LVRs vary. So we have situations where often we'll get approached to provide a valuation to a funder whose LVR is actually higher than our PI cover. And so we say to brokers, please come and tell us, because we'll often get the thing, can you do the valuation? We say, look, can you tell us who the funders you're going to approach? First of all, we want to make sure we're on the panel. B, we want to make sure we're prepared to assign a valuation to them, because some of them are cowboys. And thirdly, from a PI point of view, if you are 1% over our maximum LVR per our PI policy, the entire loan is not covered by our PI. So the funder will not do that deal, even though they might have a higher LVR. So it's really important to understand where you sit on that LVR curve and whether your valuer can actually meet your expectations in that space. And even little things with some of the major funders, whether a valuation comes through Valix or it doesn't come through Valix, that can add between 70 to 80% LVRs on some of those deals. So you may be needing to look for a funder that orders valuations through the Valix process, but then it comes back to credit, and often that obviously rules you out. But I just thought
Thank you.
Well, that gets to the point of, if the strategy is a refinance, and there's a better chance of Judo Bank doing it at a 60% LVR, then how are we going to get that LVR down between now and 12 months' time?
Yeah. Brilliant. Back to you, Ian. So from your perspective, what's the most common mistakes brokers make when relying on asset values to support an exit?
I think not. Look, obviously, if you've got a client that's refinancing and they're in some distress, that's often an area that brokers don't work in every day. So they don't, unlike where they take a borrower wants to buy a house, they take it to a bank, they take it to a Latrobe or wherever they go. Yeah. When there's some distress, often they're in territory that's not an area that they visit every day, and therefore they're not fully aware of who funders are in that marketplace, what their requirements are, their LVRs, whether they've got geographic limits, whether they've got dollar value limits, LVR limits that might not suit the deal. Yeah. But most of your valuers do know that. I'm not just talking about us, but whether you go to JLL or Colliers or one of the major firms, I'll be able to tell you, A, will they be prepared to assign the valuation? So make sure you obviously tell them who you're looking to approach. B, they'll be able to tell you, if you nominate a couple of funders, what their LVRs are, because that's what we're working with every day. What their appetite is dollar-wise, or how long the deals might take to approve. Because the number of times I've heard somebody say, so-and-so will approve, they'll do that deal in 2 to 3 weeks. Yeah, mate, we've been working for that firm, that funder for 5 years. We've never seen a deal of this, like a construction deal, inside 6 to 8 weeks. Yeah. So if you're thinking 2 weeks and 2 weeks is critical to you, this is going to end in tears. So you're really important to know your funders, and I think to use your valuers, your valuer who would be working with funders every single day of their lives, for better or for worse, and make sure you have those really relevant conversations about what the funder will do and where they'll do it. When COVID hit and a lot of funders pulled out of the market, we were getting calls from brokers on a daily basis. Do you know someone that will do this? Do you know someone that will do that? We've gone back to the old days where everyone assumes that every funder will do almost everything, and that is not the case. We're seeing these little niches now where funders are just tightening things up a bit. As soon as rates start to go up, as we're starting to see now, funders start to tailor or tighten their credit criteria and some of the conditions under which they'll lend.
Thank you. And to you, Richard, so at what point does an exit strategy stop being credible and start looking like wishful thinking from your side of the fence?
Look, from my side of the fence, when you look through a restructuring prism, I always look at, the key is to make sure any exit and restructure proposal is really evidence-based, rather than, being optimistic that, there is going to be, the white knight or the miracle new contract's going to come through, etc., that isn't on the books and is all, going to fix all the ills. So, generally we look at a restructure through a formal appointment at my end or some advisory behind the scenes. Yep. But you really are looking for, the key parts to, to be credible. That, there are forecast backed by credible information, contracts, key customers are still going to support, management's still involved, rather than, wildly optimistic assumptions. It depends on the deal, obviously. One of the major issues that I always look for is where is their taxation position at with the ATO? It's always understated whenever we speak to them. I'm always told that all lodgements are up to date and everything's in line, which is never really the truth. Superannuation and SGC is obviously a big issue. I suspect it will become an even bigger issue with the changes that are about to come through. Looking at those issues as part of a restructure and whether just obtaining new funding is going to fix the underlying problem. A lot of the time when you start thinking it's not going to be credible anymore, loss of key customers, loss of key staff, general stakeholders starting to fray at the edges. You want to be able to. I always look at it. If I have to go to the court or a regulator or anyone asks me, can you put up the restructure and justify it, based on the facts that these are the funds coming in. This was the benefit to creditors, and there was an underlying business that was able to proceed forward. If it starts getting to it can still tread water, but it's somewhat terminal underneath. You really have to make a hard assessment on whether there is an exit or there is a viable business that remains.
Awesome, thank you. And to you, Nick, just to touch on the ATO, are you seeing a lot of deals out there where the ATO is making it difficult for clients to exit?
Look, we've got a matter at the moment, actually, that all of us are well aware of, where, the ATO has action against the company and, there's a needs to be satisfied via a deed of company arrangement. But they've also gone using their powers of stepping behind the corporate veil, serve DPNs, and they're bankrupting the directors. And that's a Rubik's Cube to sort of solve that one, Two turns to the left, one to the right, and flip the thing over, and hopefully you get it done. So certainly I'm seeing, because the ATO action is getting more and more sophisticated, certainly the deals are becoming more and more complex. And then there's, then sometimes what happens is, you're looking at the exit, you're looking at the refi, and usually you're not just exiting the bank, BizCap wants to be exited as well, right, and etc. And then you've got all the money lined up, and then all of a sudden, bang, there's a DPN or there's a bankruptcy notice from the ATO. So it does make it hard. You need to be able to see around corners, and sometimes the ATO is around that corner.
For sure.
I'd say with the ATO, the hard part is you can deal with them. They are quite uncommercial at times. The hard part is getting on to the actual end decision maker. You generally have to go through the call centre or whatever, and the general operators are, I would say, somewhat unskilled at times and very uncommercial, and it does make it very difficult to be able to negotiate an outcome, and sometimes it does mean pulling the trigger on a formal appointment to be able to compromise the tax debts and refinance as part of a restructure.
For sure. Nick, back to you. When it comes to the most common exit pathways you see brokers rely on, and which ones are the ones that typically constantly disappoint lenders?
Well, firstly, when it comes to these exits, we get presented. Very often we're concerned about our own exit, right? But very often we're involved in someone else's exit, right? So we are the exit strategy, and when that hits my desk, I'm always asking, who are we bailing out here? Are we bailing out NAB and the ATO, or are we bailing out the client? Because if all we're doing is putting enough money on the table to pay the NAB and pay the ATO, and maybe pay some insolvency restructuring costs or whatever, but there's no cash left over to give the client a runway to turn the business around, then we're not bailing out the client, we're bailing out the bank. That's the first one. When it comes to different ways, like what are the ways, I guess I've just jotted down 5 different exits, and it's good to know what the different potential exits are, because when you're presenting the deal to the lender, have one of these up your sleeve. Have a plan A and a plan B. I mean, the first one is mainstream refinance, and we've talked about that. And as I said, that the trick to the mainstream finance is what's going to change.
Yeah.
You know, why aren't the banks doing it now, and what's going to change for them to do it later? Now, it may well be that they want to see a lower LVR, and here we've got a strategy for getting the LVR down. We're going to sell off a couple of trucks, and that's going to pay down the LVR, and we're also going to post a better set of numbers, hopefully, because we're changing the way we operate the business.
Sure.
Another way is the asset sale. We've got 4 properties. That 4th one was really an overreach. It was a big factory or whatever it might have been. And we're going to sell the asset. Well, are you really? Now, how often? The thing is, very often, and Ian must see it a lot as well, when particularly people fall in love with their plant and equipment. You know, they fall in love with that truck.
Yeah.
And they'll say, yeah, I'll sell it. It's like, I'm going to sell my firstborn. Don't worry. But then they think that, no, something's going to change. I'm just going to hang on to it. And, you know, maybe that, you know, it's like I'll back a winner in race 8 at Brisbane, you know, after the races have closed here in Sydney and Melbourne, and I'll get out on the last and I won't need to sell that asset.
Yep.
So mainstream refinance, asset sale, and then, you know, I like to see not just, yeah, we're going to sell it. I want to see it listed. Mm-hmm. I want to see the URL. I'd really like to see an auction date. You know, because an auction date that's a drop dead. So it's not just on the market. And that's a tough conversation you need to have with a customer.
Yeah.
With an asset sale, it might be, well, look, depending on how hairy the deal is, right? If it's, you know, sometimes you go, you know what, I can just trust them to sell the asset. That's fine. There's enough buffer in the deal. It's not dire straits. Hasn't even come near Richard's desk, right? On the other hand, it might be, look, the short-term sale of these assets is critical. I want them in the auction yard, right? But you don't have to auction them. Let's do expressions of interest.
Yeah.
You can have control over that, you know, the EIO.
EOI.
EOI, EIO. You can have control over that. So the third strategy is the business turnaround. You know, we're going to exit because we're going to turn the business around, and you're going to get paid back in the normal course of business.
Yep.
Again, that involves what's changing. Well, I was producing red widgets and the market wants blue widgets. Here's what I'm going to do to solve that. We're moving premises where we've changed. Something's changed in the business.
Yep.
And, you know, jumping from Westpac to non-bank private credit at higher rates, that's not the magic formula. However, jumping from Westpac to private credit, it's going to free up some cash. With that additional cash, we're going to turn the business around. The 4th one is the equity injection. Actually, the 4th one and the 5th one are a little bit related. Equity injection and sale of business or M&A. Now, both of those things, you know, having looked at countless M&As and I've signed more NDAs than I've had hot dinners. You know, the earnings, if the earnings multiple on a business in your industry is 10 times EBITDA and you've got a negative EBITDA, you know, selling the business is probably not a realistic strategy. Ditto the equity injection. No one wants to put equity into a business to pay me back, right? You don't go pitching to investor, hey, listen, put in $1 million and that way we can pay out Hermes. Well, that's not the plan. Usually the equity investor wants to come in, put in fresh capital and, you know, exploit some opportunity in the marketplace that isn't being exploited at the moment, that's going to get those earnings up so that they can get an uplift on their multiple. Probably talk too much, but that's it. They're the 5 golden exits.
Brilliant. Thank you, Nick. To you, Ian, so what are the characteristics that make as an asset genuinely exit friendly versus technically valuable but practically hard to realise?
Well, I think you need to break that down into sort of asset categories. So if we look at, as Nick just said, businesses, property and plant and equipment, I mean, it's the old story, isn't it? I mean, a residential subdivision in Toorak is a lot more desirable than a residential subdivision at Wangaratta.
Yep.
So, you know, in a property sense, it's the type of property, it's where it's located, and that's, you know, relatively well known. You'll know that from pretty much looking at it. Plant and equipment is a very different situation because if you look at mobile assets, obviously they are, from a disposal point of view, you've got no de-installation costs. You organise a tow truck, you pick up your yellow gear, you pick up your transport assets, your motor vehicles, and off they go. And
If you can find them.
if you can find them, which is a challenge. And then you've got manufacturing assets, which often have substantial de-installation costs, substantial transport costs, and then can take a considerable period of time to sell. And once they're removed from their current location, they've been dismantled and relocated.
If the landlord will let you into the premises.
If the landlord, yes, Mr. Positive over here. If the landlord allows us in, then you've got a process to then sell those assets. But in a lot of cases, you won't put those assets back together again, and whoever buys them, actually when they inspect them, can't actually test them and make sure that the assets are working. So you're looking at this $1 million piece of, a CNC lathe. You're told it was working when they removed it, but you don't know who actually removed it. You don't know when you put it back together again if it's going to work, but it could cost you another $100,000 to do that. And arguably what should be worth 200 to 300 grand is now worth 50. So it's a very challenging landscape to make those calls. As I said, easier on property. On the business side, what we find with business, the sale of businesses is that the process of determining the financial results of the business, or historical financial results, are probably our biggest challenge. And in some cases, the information we require is not known. In other cases, because the business has been run like a personal bank account, we simply cannot get to the bottom of how the business is trading. So when you can't actually produce something that is reliable to provide to potential purchasers, that makes a sale process or an exit from the business or bring an investor in really, really challenging. What I can say at the moment is, from our personal experience over the last sort of 2 years in particular, is that there's a lot of money out there to buy businesses. There's a lot of companies, like at our industry. You look at our industry in the valuation and auction game, there's been more activity in acquisitions and sales over the last 2 years than there has been probably over the last 25 years. There's a lot of money around for acquisitions. People recognising that getting growth in their business without buying another business is quite challenging. So if you can pick up, $1 million, $2 million, $5 million worth of extra turnover, irrespective of how that business is trading, and drop a lot of those costs away and just incorporate into your own, there's another level of value there that you can extract. But if you can't determine exactly the margin of those sales from a direct cost point of view, that makes it very hard for a business sale. And we do see that, and Nick would, and Said would see this a lot, and I'm sure Richard does too. The information we're often presented with is absolute rubbish. So, then we're trying to recreate those financials, and that can take several weeks at a point in time when you don't have that time. So that's a challenge for us. But as I say, property you can look at and make a pretty quick decision about how easy that's going to be to move. And because we're in such, maybe with the exception of Victoria, but nationally, the property market is still very hot, certainly north of the Victorian border and south of, west of the Victorian border. Every other state in the country at the moment are pushing record, certainly residential prices. Industrial still very strong. Commercial still coming out of it a little bit from COVID. And also retail still struggling a little bit, not so much at the shopping centre level, but at the small retail level. But everything else is very strong. Plant and equipment has certainly come back substantially since the heady days of COVID, when you just couldn't buy assets. Those markets have come back in some cases by half, sometimes more than that. If you recall, if you had a Toyota Land Cruiser that was a couple of years old, you get a call from a dealer offering you more than you paid for it back in 2020 or 2021. That's gone, okay, and we've now seen discounting back in the car market, discounting back in the truck market. So you're not going to see those returns, but they are liquid assets and they will sell fairly quickly with a limited amount of promotion.
Thank you. Richard, so what are the early warning signs that brokers and referrers should watch that tell them an exit strategy is already at risk?
Look, when I am advising finance clients about deals they have and looking at it as part of a restructure, there's a number of indicators. I always like to look at first about the industry and the assets and whether they've fallen. A couple of years ago, a recent one got appointed over a brewery. Ian assisted me with that. One of the major issues with that was the whole industry had really, collapsed because it had just been saturated. So, the asset values just were, they just didn't stand up, and they was significantly impaired. So, always look at, while the accounts might say, the book value is worth X, it's always whether you can achieve it in the market. The reality is, as you all know, an asset's only worth what someone's willing to pay it. So that's always a major challenge. Also like to look at, why are they looking to refinance? Have there been multiple refinances? What's the reason why they're doing that?
Yeah.
It is a bit of a red flag if they're just jumping from financier to financier. If they've done that and they haven't been able to restructure and stabilise the business, there's something wrong there.
Yeah.
So that's always a concern. And then look, it's always then just the straightforward issues after that you look at the fundamentals of the business.
Yeah.
Are all the payments up to date? What's the ageing of the creditors looking like? Is that really starting to get out? Have there been any legal issues, demands, etc. in the court? Certainly you've got to look at the tax position. I want an updated portal. I note the tax position and whether all the super's been paid. Concern there with any exit strategy or refinance is certainly don't want to tip in new finance for the ATO to issue a DPN or a winding up notice a month down the track, which has happened. I've seen before. It's not a good situation. And then when you're assessing the business and whether you think that it's starting to become imperiled, you certainly want to have faith in the company and the management. If there's high turnover or certainly turnover in the management, that is a real concern. Are there any issues with the suppliers? Are the order books being filled? So all those fundamental issues need to be looked at. If they're starting to really go the wrong way, you have to have a look at whether, if you're the existing financier, whether your facilities and the LVRs are still within tolerances, or you need to have them reassessed, or if you are looking to come in and be the new funder, about whether the business is going to continue to go south, or whether with new funding and some changes it can recover. You want to be confident that underneath the business that there's a viable core business there that might need some trimming around the edges, but if that isn't there, you're potentially just putting bad money in and you're not going to get out.
For sure. Thank you. Nick, so Ian and Richard have touched on something that I've noticed, which comes down really to information quality. When it comes to lending, what type of information quality are you currently seeing, and how important is the quality of that information when it comes to not only structuring but also structuring the exit of a lot of these deals?
Well, diabolical is some of the information quality.
Yeah.
I just wanted to say just something on
Yeah.
Richard's comment there. It's interesting. Sometimes I see scenarios and you think, what is the business model? Is the business model to, bring in widgets, repackage them, re-engineer them, whatever it might be, do so at a profit margin, beat the competition, build a better, and make money? Is that the business model? Or is the business model just to refinance? And sometimes you see and you think, this is just the business model here is refinance and refinance.
Yeah.
To answer your question, what was the question again?
The importance of information quality.
Information. Do we've got some brokers who... It's interesting because a lot of brokers now are getting just leads through... I don't know, Google lead services. I know when I delete my Facebook every now and then because it's a distraction, but you scroll and you get this message, hey broker, we can give you leads. And I think that, and you see brokers getting leads from all over the country, and then these things end up on our desk. Would you lend 80% against a block of land in Broken Hill? And that's the information.
Yeah.
That's it. And then it's like, well, okay, what's the scenario here, and trying, and the thing is, everybody in the chain doesn't want to lose the deal, right? So the broker's frightened of asking the client any questions, and then the intermediaries are frightened of asking the broker any questions. And so, there is bad information. The other thing is that often the client is in trouble because of bad information. And you must see this all the time. They don't know what's going on in their own business. They don't understand what the drivers are of the business. They don't know what their costs are. They don't know what their margins are. They don't realise that their GP isn't 60%, it's really only 40% because they're misallocating costs. And it all comes down to bad information. And so sometimes part of, if your exit is via turnaround, part of it is that if you don't have good information going forward, how's that going to change? So then the trouble is that, you're forced into this situation where you're heavily relying on the asset. And again, heavily relying on the asset is all well and good if the LVR is 40%, right? But once that LVR starts nudging up, then you need to understand how the business is going to A, service the debt, B, get the LVR down, get to that point where they're refinanceable or whatever it is the exit might be, but they're not going to get there with no information. The other thing is, if the information's bad now, Judo Bank's not going to refinance them, right? Yeah. I mean, those guys, their information, they love their information. They love their data. Yeah. So if there's not good data there, and often it's usually the accountants get blamed.
I was just about to say that.
Well, the accountant gets the blame.
I always get is that blames the accountant, and generally that means they haven't paid the accountant's bill for a long time.
The accountant hasn't paid for 3 years.
And so they haven't given them the information, and that is also a big red flag that if you can't even pay your accountant, and you can't get the up-to-date accounts and proper information, especially for SMEs who don't have, extensive back offices, that is a real worry, because they are always, one of your key advisors and suppliers that you need on site.
Can I give an example of a valuation, a business valuation we did last year? It was a financing of a second-tier bank of a first-tier bank. So we were asked to do a business valuation. It was a debt recovery business run by a firm of lawyers in New South Wales. Value of the business had previously been worked out at about 30 mil. When we looked at the financial statements, we were tracking the recoveries against what they'd paid for the books, and they never ever wrote off the residual values, even though that some of them had been in the balance sheet for 3, 4, 5 years since they bought those books. So they'd taken all the profit recovery up, as in basically the revenue less the costs of recovering those debts, but had not written down any of the book values on those books that they bought over the years. And the business is worth, it was barely profitable basically. So here there was we were given a valuation showing a $30 million valuation, and we came back and said it's somewhere between sort of 1 and 3. And these people have got no idea. We spoke to the external accountants, they didn't get it.
So they're buying the debt as an asset,
they're buying the debt as an asset, going straight on the balance sheet.
Then they're booking the income as profit.
Correct.
And the thing's still sitting there as an asset.
Yeah. So the only asset they were taking out of that was what they actually collected against. Anything that they were unable to get a collection against, they should be left in the balance sheet. So it was quite, and this is a major bank. This was one of the big four being the refinance did not go ahead by the second tier bank, and they couldn't believe it. And I said, well, I mean, sure, there's somebody within the bank that would have picked this up, because it was the first thing that we looked at. We never even finished a report. We said we're happy to finish a report, but we're talking sort of probably 1 to 3 million based on what we're looking at.
Well, this is the problem with enterprise value lending, isn't it? People often we have to explain the difference between enterprise value lending and asset value lending. The trouble with enterprise value lending is that once the enterprise starts tanking, the value tanks. Well, firstly, they can't service the debt, so you're not getting paid out through cash flow, and then there's no chance of recovering by selling the asset or the business.
The other thing I was going to say, definitions of value that are used in valuing different types of assets are also really critical. And if you look at a property valuation, you'll often see a clause in the valuation if the property is not quite mainstream or it's not in a geographic area which is selling on a 4 to 6 week timeline. It'll say this property has got an average market selling period of 6 months, 6 to 9 months. But you get a situation where a lot of funders will lend on a market value basis in terms of LVR, and then when it comes time to recover, they'll want to recover on a forced liquidation value basis. So instead of waiting 6 to 9 months for a sale, they want to sell it, put it to auction, get a sale away in 4 to 6 weeks, and it just literally tanks the value. And we see that a lot. And we say to people, if you're having a default, come and talk to your valuer, irrespective of whether it's us or somebody else. Talk to the valuer and ask them 2 things. How long is this going to take to sell in the current market? And B, who's the best agent in that area to sell that asset? Because often, and again, we see this all the time, the funders go to the local agents, they take the lowest price, they do no analysis of the quality of the agent itself, and that can have a massive impact on the end value of the asset, whether that's property or any other type of asset. So that's just something that we see, again, a critical issue that we confront literally on a daily, weekly basis.
Yeah, thank you guys. Back to you, Nick. So if a broker could improve just one thing when presenting an exit to your credit committee, what would make the biggest difference?
I think it's just making sure that the exit's credible.
Yeah.
It's a credible exit, and there being a fallback, because the question is, what happens if this exit doesn't happen? Yeah. You know, that's why in our business we're not pure asset. You know, there's a lot of lenders there that just lend against property, and one of our criteria is we want there to be a trading business. Sure. And the reason we want there to be a trading business is that if the exit blows up, well, then they at least hopefully, you know, then they can keep servicing the debt. You know, because often you're asked, oh, can you capitalise 6 months interest? You go, well, that's okay. We'll do that. Obviously, it comes out of the available funds. But if the magical exit doesn't happen, then there's a business there. You know. Now, I would hate to be one of these private credit funds that don't do that. All they're doing, and there's a lot of them, and must see them all the time. And the thing is, a lot of these private credit funds also, they don't have experience. Right, so it's all good on paper. Look, we're going to do this, capitalise the interest, and the thing will sell in 6 months. Then all of a sudden they've got to take control of that asset, and they find out, you know what, you don't just put it to market. You got to, you know, you've got to get control of the asset. And guess what? The tenants or the owner occupier doesn't want to vacate that asset, and then they want to question, you know, that you even have the right to it, and then you're in court for 12 months, and you know what? You know, so the thing is to, you know, we like to have a plan B, and usually our plan B is that there's a trading business, and if it all goes wrong, then at the end of the 6 month or 12-month period, they can service the debt, at least service the interest through the business. So for me, it's a credible exit. It's not just refinance or, you know, they're going to sell. You know, don't worry about that. They're going to sell this asset that they love. And, you know, because the other problem is, of course, and you see it particularly in businesses, where the valuation is sometimes a matter of opinion to some extent, you know what I mean? Not to denigrate the business valuation process. But, you know, how often do you see, well, I was offered $1 million for this asset, but really it's worth $2 million, you know? And no, it's worth $1 million.
That's what I call the Dreamtime effect.
The Dreamtime effect. I thought you were talking about rainbow snakes and all that sort of stuff. But, you know, so because then the question is, and we often ask it at our credit committee, is what happens when they get a good offer, but they knock it back because they're living in this dream time where the asset's worth, where they think the asset's worth a lot more. And sometimes that's driven by a bump valuation. You know, there's certain values that we won't touch because we know the valuations are just completely unrealistic. The client's then got that number in their head. They go to market and they think they're getting robbed unless they get that valuation. That then delays the process. The loan goes into default. So I think a credible exit, and you know, you've got to have willing buyer and willing seller if that's what the exit is, and a credible backup plan.
Sure.
To that point, I'd also say, look, one of the issues that I see, it's not necessarily that they get a number from a valuer. A lot of time directors want a certain value that goes to lifestyle concerns that even though it's X, you know, to pay out the funder, they also want to achieve a certain number to be able to, you know, get funds for themselves. So that is always a bit of a headache as well, trying to get through those issues that it's not necessarily, you know, the director's want of a certain figure is not based on any business fact. It's that, you know, they need X number to be able to service whatever they want to do in the background.
Well, there's a bit of sunk cost fallacy and that sort of thing in that, isn't there? It's a little bit like, you know, I want to get $5,000 for my car. I just spent $2,000 on a new carby and all that sort of stuff. The buyer of the car doesn't care.
Yeah.
They assume that when they turn the key, the thing's going to drive away.
Yeah.
And they don't care. But often that's sort of built into that, right?
We get that in hospitality a lot, where, you know, owners will say, I spent, you know, a couple $100 grand on a fit out, and I always have to say, well, it's a sunk cost. It's not worth anything on an exit or a sale, you can't rip pizza ovens out of walls, et cetera, because you've got make good and you've got damages. So there's always those concerns, and there's always a difference between the emotional attachment to whatever was spent and the realistic value or what it can be sold for.
Brilliant. Back to you, Ian. So when lenders say they want a realistic exit via an asset sale or refinance, what evidence do valuations need to show for credit teams to actually believe it?
Well, look, again, it depends on the asset.
Yep.
In the SME space and business valuation, it's very, very hard to show comparable sales, but we tend to work on cap rates.
Sure.
We'll also look at what the market is like, irrespective of cap rates, to another business in the same marketplace. And there's often value that's over and above, substantially over and above what you'd expect in a standalone business sale. And most business valuations instructions are based on a standalone business sale.
Yep.
In terms of property, again, within the report, you often see the comparables. It's pretty easy to have a look and go, yep, I can see the comparables. That sold a month ago for X, this sold 2 months ago for Y. Very similar properties, I'm comfortable with the number.
Yep.
P&E can be quite challenging. Very easy on mobile assets. Large manufacturing facilities, very challenging because you don't see those assets being traded publicly that often anymore. We've got a very small manufacturing base in Australia, which, notwithstanding whichever government is in office, it seems to be shrinking at an increasing rate to the point now where we don't make almost anything here.
Yeah.
So where we don't have those comparables, we have to go offshore and we have to look for them in places like the US. But having an overseas buyer come into a market, unless it's a major acquisition, is unlikely.
Yeah.
So you're sort of extrapolating. So the P&E side of it is much tougher than property. I think I've got a couple of my team here on the P&E side that they would agree that because of the diversity of assets, the complexity, the installation costs, transport costs are much harder to define for a potential purchaser. Therefore, arriving at an accurate value is much more challenging. And we battle with that every day. And look, we've been working with Nick and you and the team for a very long time. We'd much rather value property than plant and equipment from a complexity point of view. Every day.
Sure.
It's much easier to demonstrate value in those situations.
Brilliant. Thank you. Richard, in your experience, what role can private credit play in a successful turnaround, and when does it simply delay the inevitable?
Oh, look, private credit in the current marketplace is incredibly important. I mean, big four banks constantly retreat. A lot of them, are in and out of love with genuine business lending. And they generally not the party who's going to be the new funder of a restructure and a turnaround. It's generally private credit. So it plays a really important part of being able to, give the business breathing space, and fund a credible turnaround. It allows the time to be able to come up with a turnaround plan, and also, fund the core activities. One of the major parts, obviously, I would see as part of a voluntary administration and a DOCA. It allows it to take out, an old lender or financier who doesn't want to be part of the business anymore. And also allows to fund, a deed of company arrangement up front, where you are compromising the company's debts, especially the ATO debt is the major one that happens, with cents in the dollar. And a lot of the time, one of the selling points is a very large chunk, or the DOCA fund is paid, within a very short period of time because of that new funder coming in. Obviously, always recommend to the new funder to, not provide the funding until the DOCA has been approved by creditors. You certainly, can come to terms and be on, be a willing participant, but you want to be able to crystallise those debts before you put in any of your own capital. You don't want a risk of it, potentially not getting up and then those funds just being dissipated. So it is a really important part of the current marketplace. It's only going from strength to strength, and there's new players coming in all the time.
Yep.
It allows for the business to, get, additional working capital, complete its work in progress, hopefully be able to bridge the gap to a key new contract or something like that come on.
Sure.
The concerns that you really need to look for is, you certainly don't want it just to plug operational losses and not fix the underlying issue.
Sure.
There's no point funding a new business or recapitalising it if the underlying loss-making issues are just going to continue on, and we're really giving it, an extra 12 or 18 months to the inevitable still come on. Going back on the original one, you want the turnaround plan to be based on evidence, not just aspirational. So, again, you don't want, contracts that aren't on foot or, fictitious, we're going to pick up all this extra work that hasn't got any credibility. And, the other issues that we talked about key stakeholders being on board. For sure. It's not that credible if those issues are under risk or, there are genuine exits, including management and key customers. So,
brilliant. Yeah. Thank you. Any final thoughts from you guys? Nick, Ian?
Well, there's one thing I didn't raise before, and it comes down particularly in the property security space, and that is that commercial property in particular, when it comes up for sale or for valuation prior to sale, we're often instructed, depending on the lender, to value on a vacant possession basis, even though there's a lease in place, and that might even be an arm's length lease. And I know we often get queried from borrowers, often company directors, about, they've had a tenant, they've got a 5-year lease plus options with a arm's length party. It's at a solid market rent, it's not inflated, but yet the funder simply will not take into account the lease in terms of the value of the property. Now that's something that needs to be explored again at the time that you're approaching a funder for funds, not at the back end when all the instructions come through to us and we then do the valuation on the basis of vacant possession, which will lead to often a much lower value than with a tenant on board. So that's something we see quite a bit of, and it does vary a lot between lenders, particularly in the non-bank space, where the more conservative they are, they're really not interested in the value of a tenant. It's just a vacant possession basis.
For sure. Thank you. We might move to Q&A. Yeah. Any questions, guys, for us?
Yeah, probably. Obviously, thanks again, guys, for obviously sharing the information through. What are you sort of seeing? Is there any particular industries that are a lot more insolvent these days? But what are you kind of seeing on the property side or a bit more on the...
Look, from my end, there's always some staples: hospitality, construction, certain parts of transportation. It's always a very cost prohibitive. There's a lot of disruption in transportation at the moment, which I'm sure Ian's seeing. There's a lot of interesting gear being run up and down the East Coast at the moment. So they're always the niche ones. Look, it depends. I've seen a lot of NDIS businesses recently. Look, it seems like there's only two things in NDIS. You're either defrauding the government or you're a true believer and you're losing money. There doesn't seem to be anyone else in between at the moment. Childcare centres, I've been appointed over a few. There are obviously the ones that are operated well, make a lot of money, but there are a lot of operators in the space. And I was appointed over one recently. They're just expanded way too quick, and shot for the stars, and it all sort of blew up. They're the main ones at the moment. But I would say in general that there's a fair bit of pain in the marketplace in general at the moment. There's a lot of businesses treading water. The ATO is aggressive, and I can only see them, staying pat, if not increasing, the recoveries, especially the DPNs. That it will stay in the marketplace, and it touches all industries and categories really. And the ATO have become a lot more difficult on small business restructures and approving them. At the start, if you met the core fundamentals, they were not waving them through, but approving a lot of them. Now they have become a lot more scrutiny on the plan, especially around bad lodgements history. With bad lodgement history, the ATO are rejecting them, I find, and therefore a lot of appointments are going back to straight liquidations and voluntary administrations to try and turn it around. So,
can I add a little bit to that? For the first time in a long time, we've seen childcare, so we've probably valued about 75, 80 childcare centres last year, mostly for refinance. But we saw several in insolvency scenarios, and for the first time in my recollection, actually seen situations where there were no buyers. We weren't selling the businesses; they were being sold by insolvency practitioners. But for the first time that I've seen, we've seen Chockers just close their doors. Basically, that's been something that we've seen. I think the winery sector, we haven't seen it live yet, but I've got a lot of connections in the wine space. The wineries are really doing it tough.
They're doing it tough now?
Yeah, they've been doing it tough.
When were they doing it okay?
Well,
I was appointed to a winery late last year. It was mainly in the bulk wine, and it's a rough.
It's been a
time.
tough space for a long time, and that affects property valuations as well. Because if we've seen valuations where it's really valued as a winery, and even though it's not a business valuation, which we're not interested in. Unless it's sold as a winery, with vines. And then the trouble is, if you can't, it's not just badly run. It's just the fact that the industry is cactus.
Well, I think it's a combination of, you look at the large wine, the Treasury Wine Estates, the Casellas. They've come and they've bought all these premium brands, but they're premium because they were boutique and they had their own, the family connections and their own marketing plans. And they go into Treasury Wine Estates, which owns Penfolds, and suddenly they're one of 400 different brands. That mystique, the magic, the passion, gone. I mean, Lindeman's, for those that know wine, they're the trio, the Pyrrhus, the St George, the Limestone Ridge. Wine's been around for 60 years, have been super premium wines, have been destroyed by Penfolds. They've just stopped. The 2022 vintage was the last vintage of those wines, which are iconic Australian wines. Couldn't sell them, unable to sell a number of the vineyards. Casellas have got all of their premium wines, premium vineyards that they bought, including Peter Lehmann, on the market. Peter Lehmann's been on the market now for 2 years, no sale.
There's also such a glut of the bulk wine, Australia and around the world. It's just the reserves are huge, and it's just not, it's just not worth. And you can't. You're all competing over the same contracts.
With falling wine consumption.
I think though, the positive to come out, I think, of this is that the question is the role of the finance broker, right? Because we can pick at any industry and say why things are bad in that industry. But the reality is our client is a small business operator that, a little bit like me or any of you guys really, if you're a broker for yourself, we're probably unemployable. And we've gone out into the wild and trying to make a living, and that and we're trying to help that client. And the thing is that as the broker is to sort of try and help the client avoid the situation where they're going from one exit to another exit to another exit to another exit, and all the way they're just losing a little bit each time, a little bit, and every time they're just debilitated more and more, and sometimes having tough conversations with clients, saying, listen, we need to, in order to, you need to change something in the business to give yourself a better future, so you're not relying on. You want. I always say the journey for me, where I think, we've had a success, is when we've bailed a client out. We've been the exit strategy, and then the clients exited us and gone to a bank. And that's because maybe they've worked closely with their broker or worked closely with their advisors, got the business into a better place. And when the exit from private credit is to a bank, I take that as a personal win because we've served our role. We've nursed the client through bad times. Now the trouble is, I've got a little saying, don't do business with someone who wins when you lose. And there are bad actors in the private credit space who, I mentioned one before, I'm not naming any names, but they won as soon as they refinanced us. They took a $400,000 fee. They didn't bank the fee. It was obviously it was an accounting entry out of the assets, and when they finally liquidate that business, which is all they care about, so you've got to have the right exit partner and help the client be on a strategy, have the tough conversation. Clients don't like having tough conversations. They shop around for someone who tells them the easy thing. But we want to try and help these small businesses get to a better place. They've got a future for their families, and they love everybody involved. They love the broker, and we get thank yous and all the rest of it. That's what we want. We don't want to be in a situation where it's a virtual loan to own, you know, and
Yeah.
that's you know, and I'm sure you love seeing a win as well. You don't want to see them back again.
I want every docker to get up and they go on. I mean, the one where they're cancelled and you have to come back in, it's difficult. You know, no one's a winner, and generally, you know, everyone's left shorthanded. So,
And everyone's got a bad taste in their mouth.
Exactly,
The accountant that referred it to you is probably blaming you, and you know what I mean.
There's a lot of blame to go around everywhere. I mean, and especially when, you know, there's then scrutiny about, well, why, if the business failed, why did Docker get up, and all the rest of it. So, a successful restructure is always what I aim for anyway. And you know, you can always take those examples and use it for the next one as well as a positive example of, you know, go and speak to this director. We were able to help him out, and these, you know, with a similar set of circumstances that you're facing.
Brilliant. Awesome. Well, we might wrap it up there.
Yep.
Thank you guys all for your
Thanks, Elias.
contributions. Fantastic. And thank you all for your time this morning. Brilliant.
Thank you.
Thank you.
Thank you.